Hello, everyone. I hope you're having a good week. Thought I'd spend some time on taxes before the end of the year. I know there's not much time to go, but I thought it might be a good place to give you a little bit of information. Now is the time to take that last look at your income taxes for 2021, which for most people is due on April 15th, 2022. And Congress, I know, is looking at the tax code. There may be some changes for some people, although most people I don't think will be affected. Now, if you feel that 2022 might bring lower taxes for you, for example, then deferring income to the next year is perhaps a good option. If you use the cash basis method of accounting and own a business, you might be able to delay a bonus, for example. If the reverse is true, you might take that number in 2022 or 2021, right? It depends on where you would have the best tax effect. You can do the same planning with your deductions. By choosing the payments in one year versus another, you have some control over these. The key is to review 2 years at a time. One area to review are deductible charitable contributions. Deductions for charitable contributions is generally limited to a certain percentage of your adjusted gross income. Your deduction also depends on the type of property you are giving and the organization you are giving to. For 2021, even taxpayers that don't itemize can deduct $300 or $600 on a joint return for direct cash gifts to charity. The reason for bunching those deductions is it might get you over the standard deduction where you actually do get a benefit for doing charity. Now, another place to do charitable contributions is with your required minimum distributions. You don't get to pay taxes on it. Now, last year in 2020, you did not have to take your required minimum distributions, but you do this year from traditional IRAs and most employer-sponsored retirement plans. This has to be done by the end of the year, December 31st. There's a substantial penalty if you don't take it of 50% of the amount you were supposed to take. These rules also apply to inherited retirement accounts. As the penalties are steep, it's worth checking the status of your required minimum distributions. It is also a good time to review your retirement savings. This includes deductible contributions to traditional IRAs and pre-tax contributions to employer-sponsored retirement plans. I've had people in the last month of the year raise their contributions to 100% of their pay so they could get to the maximum or close to it. So take a look at it. You also need to remember that the IRA, you don't have to do by the end of the year. A deductible IRA, if you qualify, can be done up to April 15th of next year for this year. Another potential area to review is your portfolio. That's taxable, a brokerage account. You may have some capital gains and losses. You may want to offset those gains with the losses so that you don't pay gains if that works out in your favor. If you take excess losses, you can deduct up to $3,000 against your ordinary income and carry the rest forward for future years. If you feel capital gains rates will be higher in the future, you might want to save the capital losses for later years or take some gains this year. Part of the requirement for mutual funds is the distribution of any gains they have for the sale of stock and bonds during the year to their shareholders. So if you have mutual funds in your taxable account, you're going to want to check with the mutual fund company to determine what their expected distributions are. They usually post these in December timeframe, end of November, December, so we're about there. And that can be a good idea to take a look at to make sure your tax picture will be under control. Now, the quick tax projection is another thing you can do to be helpful. If it seems like you are going to owe money, consider increasing your withholdings for the last month or so of the year. You can do this by submitting a Form W-4 to your employer. Increasing your withholding could make sense to help you avoid penalties. The withholding is considered made evenly throughout the year instead of on the day you paid it.